Hello, traders. Welcome back to another episode of the comprehensive course on options trading. In the previous episode, we have talked about call options from the perspective of both buyer and seller. We have discussed the P&L profile and also looked at the payoff diagrams. In this episode, we are going to learn about put options. Puts and calls are like opposite faces of a coin. The outlook of the traders entering into a put contract is the opposite to the one entering into a call option agreement. We will look at the expectations, profit and loss profiles, along with the payoff diagrams of both the buyer and writer of a put option. If you have a clear understanding of the concepts of a call option from both the buyer's and seller's perspective, then familiarizing put options is just a piece of cake. We will start with the case of a put buyer. Let's begin with a formal definition of a put option contract. The buyer of the put option has a right, but not the obligation, to sell an agreed quantity of a particular financial instrument or underlying from the seller of the option at a certain time or expiration date for a certain price called the strike price. The seller or writer of the put option is obligated to buy the financial instrument should the buyer so decide. The buyer pays a fee called premium for obtaining this right. So the key word here is the right to sell. Unlike a call option buyer who has a bullish view on the market, the put buyer has a bearish expectations from the market. The put option buyer is betting on the fact that stock price will decline by the time expiry approaches. In order to profit from this outlook, the buyer enters into a put option agreement. In a put option agreement, the buyer of the put option gets the right to sell the stock to the put option writer at a predetermined strike price upon expiry, irrespective of where the underlying stock is trading at. This contract involves paying an upfront premium by the put option buyer to the seller for obtaining this right. Since the put option buyer expects the market to go down by the expiry, the put option seller would take the opposite bet where he anticipates the stock prices to rise up or stay flat. This would in turn mean that put option seller will have to buy the stock upon expiry if the put option buyer decides to sell. Or in other words, the seller has an obligation. So it is up to the put option buyer to decide whether to exercise his right to sell or not. But as we have studied in the first episode, the put contract buyer will exercise his right to sell only if the underlying price or spot price is trading below the strike price. In such a scenario, the put buyer can sell the underlying at a much higher price to the put writer when the same underlying asset is trading at a much lower price in the open market. Now, in the other two scenarios, where the spot price becomes greater than the strike price, or if the underlying price stays flat with the strike upon expiry, then the put buyer would not use his right to sell. He would just walk away with a loss which is not more than the initial premium paid to the seller. So a put option buyer profits on only one out of the three outcomes in the market. So the basic guidelines to keep in mind with put options from a buyer's perspective are the following. It makes sense to buy a put option only when you anticipate that the price of the underlying asset will decline. If the underlying price stays the same or increases, the buyer of the put option will incur a loss. The amount of money the buyer of the put option would lose will be equal to the premium paid to the seller or writer of the put option. To solidify these concepts, let us consider an example. This is the one-day time frame chart of Bharti Airtel stock. It is currently trading at approximately 1460 rupees in the market. The stock has been creating consistent higher highs and higher lows for the last few months, suggesting a strong uptrend. But recently, the stock broke down below the trend line and it was unable to create a new higher high. Instead, it took a resistance and started to fall lower. I am bearish about the stock for the short term and I anticipate the stock price to decrease even more, at least till the support level at 1380. If you can see, there is another support level at 1420 also. So this level might possibly trigger a reversal. Since I am planning to take a trade against the trend and because I am a little worried about this intermediate support level, I'm not willing to sell the futures. I don't really want to be bothered by the M2M fluctuations. And since it might take a few days to attain the target, shorting equities is also not an option, as short selling of equity stocks can only be done on an intraday basis. As I don't want to miss out on this opportunity of a price decline, I decided to buy a put option contract. Since I want to play this safe, I will select the 1420 level as my strike price. Selection of a strike price in itself is a broad topic to understand. We will definitely talk about it in our upcoming episodes. Anyway, this is the option chain of Bharti Airtel, and there are almost 20 days till expiry. The strike prices are arranged in the center of the option chain. For Airtel, the difference between the two strikes is 20 points. Our objective is to buy put options. Put options are located to the right hand side of the strike prices. Our desired strike price of 1420 is now trading at a premium of 9.8 rupees. Also, the lot size of Bharti Airtel options is 475 shares. So the total premium turns out to be 4655 rupees for a single lot. But for the sake of easy calculation, we will assume the 1420 put option premium to be 10 rupees and also the lot size to be 1 share, meaning 1 lot is equal to 1 share. This means the total premium required to buy 1 lot will be equal to 10 rupees. Remember, to buy this 1420 put option, the buyer will have to pay the required premium of 10 rupees and the same will be received by the 1420 put option seller. Anyways, you bought 1 lot of Bharti Airtel 1420 put option. Usually, a put option is abbreviated as PE. So, Bharti Airtel 1420 put option is referred to as Bharti Airtel 1420 PE. PE is an abbreviation for European put option. You may already be familiar with what a European put contract is from the first episode. Anyways, we will now look into different scenarios that could come up after 20 days, which is the expiry day for our put option contract. The first case is when the stock price drops below the strike price to say 1400 rupees. The second scenario happens if the spot price stays above the strike price at say 1450 rupees. And the last case is when the stock price is equal to the strike price at 1420. The next step is to find the intrinsic value of our 1420 put option for these different spot prices upon expiry. We have already discussed the concept of intrinsic value in the previous episode. Hence, I am assuming you know the concept behind IV. In short, intrinsic value or IV is the non-negative value that the option buyer is entitled to if he were to exercise the option upon expiry. In simple words, IV represents the value of money the buyer will receive if he were to exercise the option upon expiry. As stated, IV is always a non-negative value. This means upon expiry, if the option is not profitable or if the intrinsic value between the spot and strike price is negative, then the intrinsic value will be considered as 0. From the previous episode, we already know the intrinsic value of a call option. It is just the maximum value of 0 and the difference between the spot price and the strike price. Now, the calculation for intrinsic value of put option is slightly different from that of a call option. The IV for a put option upon expiry is the maximum value of 0 and the difference between the strike price and spot price. I have highlighted the difference here. Always remember that these formulas, which are used to calculate the intrinsic value of an option, is applicable only on the day of the expiry. However, the calculation of the intrinsic value of an option is different during the series. We will understand this difference as we move forward in this video. Anyways, the intrinsic value of our 1420 put option for different spot prices like 1400, 1450 and 1420 upon expiry will turn out to be 20, 0 and 0 respectively. You can see the detailed calculations on the screen. Now, keeping this concept of intrinsic value of a put option in perspective, let us build a table which would help us identify how much money the buyer of Bharti Airtel 1420 put option would make under various possible spot value changes of the underlying stock upon expiry. Keep in mind that the buyer has already paid a premium of 10 rupees for this option. Irrespective of how the spot value changes, fact that the buyer has already paid 10 rupees will remain unchanged. This premium amount is debited from the buyer's account, or in other words, this is the total cost incurred to buy the put option. Since the premium paid is a debt transaction or simply a cash outflow, we will represent it with a negative sign before it. I have built a profit and loss table using different values of spot markets upon expiry. If you look at it carefully, you will observe two important things. First, even if the price of Airtel surges, the maximum loss of the put option buyer is capped at 10 rupees. In other words, the maximum loss is restricted to the extent of premium the option buyer has paid. The second observation is that the profits from the put option seems to increase exponentially as and when Airtel stock starts to decline below the strike price of 1420. In other words, buy a put option only when you are bearish about the underlying. From these two observations, it is fair for us to say that the buyer of the put option has a limited risk but has a potential to make an unlimited profit. This calculation is fairly simple. The general formula for finding the put option P&L for a given spot price upon expiry is given by the difference between the intrinsic value and premium paid. If you expand the IV term, the formula would look something like this. Please do bear in mind that this formula is applicable on positions that are held till the expiry. As you can observe, the basic formula for calculating the P&L for a put option is same as that of a call option, but the calculation of the IV term is different. Anyways, let us pick three random spot price values like say 1390, 1440 and 1415. We will apply this to the formula and see the results. The spot price of 1390 is way below our strike price of 1420. So we expect the put buyer to be profitable upon expiry. And as expected, the formula returns a profit of 20 rupees. For the spot price value of 1440, which remains above the strike price, we expect the put option buyer to bear a loss. The formula returns a loss of 10 rupees. This amount equals to the upfront premium that has been paid. Now, in the third case, for the spot value of 1415, which is slightly below our strike price, what is your expectation? While putting in the value, the formula returns a loss of 5 rupees. Now, how did this happen? This violates our observation that upon expiry, if the spot price is below the strike price, the put buyer makes exponential profits. But despite the spot price being above the strike price, the trade resulted in a loss. But if you notice carefully, this loss of 5 rupees is way lesser than the maximum loss of 10 rupees. To understand why this happened, we will have to return back to our table once again. As you can notice, the put buyer suffers a maximum loss till the spot price becomes equal to the strike price, that is until 1420. However, as and when the spot price begins to drop below the strike price, the losses started to reduce. The losses keep getting minimized till a point where the trade neither resulted in a profit nor a loss. This point, where the P&L turns to zero, is called the break-even point. And below the break-even point, the profit starts to rise exponentially. We have already discussed this concept in terms of call option, where the break-even point was obtained as a sum of the strike price and the premium paid. However, the formula for finding the break-even point of a put option is slightly different. For a put option, the break-even point is obtained as the difference between the strike price and the premium paid. In the Bharti Airtel example, the break-even point comes out to be 1410. So if the spot price at the expiry is 1410 rupees, then there is no profit or loss for the put buyer. The P&L will be equal to 0. In other words, the put buyer will neither make money nor lose money. To validate if this is true, you can apply the break-even point into the P&L formula and it will return a value of 0, which is clearly in line with the expectation of break-even point. And let me remind you once again that the calculation of intrinsic value, P&L and break-even point are all done with respect to the expiry. Just keep that in mind. Considering all these generalizations, we will now construct a payoff graph for a put option buyer upon expiry. For this, we just have to connect the P&L points from the table and we can develop a line chart like this. From this chart, you can visualize all the important points that we have learned until now. If you look at it, you will notice that the maximum loss the buyer of a put option experiences is to the extent of the premium paid, which in this case is 10 rupees. The put option buyer experiences a loss as long as the spot price is above the strike price. Towards the left end of the chart, you will realize that the put option buyer has the potential to realize unlimited and exponential profits provided the spot price moves lower than the strike price. Even though the put option is supposed to make a profit when the spot price moves below the strike price, the put option buyer first needs to recover the premium he has paid. The point at which the put option buyer completely recovers the premium he has paid is called the break-even point, which in this example is 1410 rupees. Below this level, the put option buyer truly starts making a profit. But the important thing to note here is that the put option buyer has to be directionally right in order to become profitable. Only if the underlying price falls below the difference between the strike price and the premium paid upon expiry will the buyer of the put option be able to make money. In all other cases, he stands to lose his premium amount completely or partially. So buying a naked put option is kind of similar to selling equities or futures, but with options, your downside or risk is capped. You know how much you are going to lose from the beginning of your trade. And with this, I hope you have a clear understanding of put options from a buyer's perspective. Now we will look at put options from a seller's perspective. In the previous episode itself, we have understood that an option buyer and seller has opposite views and expectations out of the market. Therefore, we can think of them as perfect mirror images. Just like how mirror images appear as a reversed version of the object, whatever happens to the put option seller in terms of P&L, the exact opposite happens to the put option buyer and vice versa. For example, if the option writer is making 50 rupees in profits, this automatically means the option buyer is losing 50 rupees. Going by this idea, if the put option buyer is bearish about the market, then clearly the put option seller must have a bullish view on the markets. Let's consider the Bharti Airtel example again, but from the perspective of a put option seller. The thought process of a put option seller is entirely different. This is the daily time frame chart of Bharti Airtel. Airtel stock is currently trading at 1475 rupees in the spot market. The stock is in an uptrend for quite some time. It is now trading near a strong support level at 1420. This support level has sustained prices for a few times. Therefore, you can anticipate the price to remain above this level at least until expiry. There are about 15 days to expiry. You don't want to short futures as you don't want to be bothered by the M2M fluctuations. And since you don't want to miss out on this opportunity, you decided to short a put option. Now, you might have a question in your mind. If you are bullish about a stock, why write a put option? And why not just buy a call option instead? This is a solid question. But the decision to either buy a call option or short a put option really depends on how attractive the premiums are and how strong your bullish outlook is. At the time of taking the decision, if the call option has a low premium, then buying a call option would make sense. Likewise, if the put option is trading at a very high premium, then selling the put option and collecting the premium would make sense. Likewise, if you are strongly bullish, then buying a call option is the best choice to make. But if you are less bullish or doubtful, then shorting a put option is the way to go about it. In this case, let us assume you are not expecting a breakout and rally above the resistance level. Therefore, you are less bullish about the stock's short-term performance. Now, looking at the option chain of Bharti Airtel for the current month expiry, you decide to select the 1420 put option as your strike price, assuming this level would hold. The 1420 strike price is trading at a premium of 7 rupees. For the sake of easy calculations, we will assume that one lot is equal to one share. So, you short one lot of Bharti Airtel 1420 PE Once you do that, you will receive the premium amount of 7 rupees. In other words, your account get credited or there is a cash inflow into your account. But on the other hand, when you write options, regardless of calls or puts, margins will be blocked in your account. We have already discussed why this is the case in the previous episode. In short, this is done to reduce the risk of default the broker has to face if the put writer goes into deep losses and he may not be able to pay off his obligations. Now, just like the previous cases, we will consider the P&L profile of a put option seller and then make a few generalizations. Remember the fact that the formula for intrinsic value calculation upon expiry for both the buyer and seller of put options are the same. However, there is a slight modification in the P&L calculation. We will take a look at this now. So, when an option seller sells options, he receives a premium. The writer would experience a loss only after he loses the entire premium. With respect to our current example, after receiving a premium of 7 rupees, even if you lose 5 rupees, you are still in a profit of 2 rupees. Hence, for an option seller to experience a loss, he has to first lose the entire premium he has received, and any money he loses over and above the premium received will be his actual loss. Therefore, the P&L calculation of an option seller upon expiry would actually be the difference between the premium received and the intrinsic value. On expanding the intrinsic value term, the equation would look something like this. By making use of this equation, we will create a table for the profit and loss profile for different spot prices of Bharti Airtel stock upon expiry. Now, this is how the table would look like. From the table, it is evident that as long as the spot price stays at or above the strike price of 1420, the put option writer gets to pocket the entire premium value of 7 rupees. So the profit remains constant and it is equal to the premium value. However, the seller starts to experience losses as and when the spot price begins to move below the strike price of 1420. But as you can notice, the losses don't start to show up right after 1420 level is breached. At first, it eats into the premium received and only then the losses becomes evident. This is where the concept of break-even point becomes significant. We will understand these using some quick examples. For this, we will assume 3 potential spot prices where Airtel stock could end up on expiry. Let these prices be 1450, 1380 and 1415. Now putting the first value into the equation, the result comes out to be a profit of 7 rupees. Since spot price is higher than the strike price, the intrinsic value term becomes 0 and the seller gets to retain the premium amount of 7 rupees. This also means the overall profit is restricted to the extent of premium received. Now applying the second value into the equation, the outcome will be a loss of 33 rupees. Since the spot value is much lower than the strike price, it rejects the put writer's overall outlook of price staying above the strike price upon expiry. This result in the put writer's loss. So put option writers would experience a loss as and when the spot price goes below the strike price. And lower the spot price moves away from the strike price, the larger is the loss incurred. Now putting the spot price of 1450 into the equation, the final result comes out to be 2 rupees. This means the put seller is still in a profit even though the spot price is trading below the strike value. If it were the case of a put buyer, he would have been in a loss of 5 rupees in this scenario. This is clearly because of the break-even point or breakdown point concept, which we have already discussed earlier. Even when the spot price decreases lower than the strike price, the put option writer still makes money and he continues to make money till the spot price declines below the difference between the strike price and premium received. At this point, he starts to lose money. Hence, this point is the break-even point or breakdown point. As you can clearly see, there is no change in the break-even point equation. The break-even point for a put option buyer also becomes the break-even point for a put option seller. In this case, the break-even point is at 1413. Below this level, the seller would start to experience exponential losses. Therefore, it is fair to conclude that a put option writer has the potential to earn limited profits but can experience unlimited losses. With that being said, let's plot the put option seller's payoff chart. We will use the P&L table for this purpose. This is how the chart would look like. Just like I have mentioned, the put option seller's P&L payoff chart looks like a mirror image of a put option buyer's P&L payoff chart. You can notice how the profit is restricted to 7 rupees as long as the spot price is trading at any price above the strike price of 1420. Between the strike price of 1420 and the breakdown point of 1413, we can see the profits getting minimized. At 1413, we can see that the seller makes neither a profit nor a loss. And below 1413, the put option seller starts losing money. In fact, the slope of the line clearly indicates that the losses starts to increase exponentially as and when the spot value moves below the break-even price. I hope you now have a clarity on put options. In fact, I have kept the payoff charts of both put option buyer and seller side by side. Now, if you think only about the risk component of these players, you will realize that the put buyer bears limited risk, which is equal to the premium amount required to be paid to the seller of the option in order to buy the right to exercise the option upon expiry. But on the contrary, when you think about the risk profile of a put option seller, you will realize that he bears an unlimited risk. His potential losses can increase exponentially as and when the spot price moves below the break-even price. This is important to consider because what if the loss becomes so large that the seller won't be able to manage it? And even worse, what if the seller defaults on the contract? The exchanges and brokers don't want to risk this at all. This is the reason why there is a high barrier for entry when it comes to selling options. You are required to maintain a higher amount of margin in order to sell even one lot of an option contract. It is also mandatory for an option seller to maintain some of this margin as cash in their account. The margin requirements for an option seller are almost similar to the margin requirements for a futures contract. This is usually done to reduce the risk of default. Here I have attached screenshot of the margin requirements. You can see the difference for yourself. So far, in this episode as well as the previous episode, we have assumed that you as an option buyer or seller would set up an options trade with an intention to hold the same till expiry. But in real market scenarios, more often than not, you will initiate an option trade and close it much earlier than expiry. In other words, we trade changes in premiums. Under such a situation, the calculation of break-even point may not matter much. However, the calculation of P&L and intrinsic value does matter, and there is an entirely different formula to do the same. To understand this more clearly, let us assume two situations on Reliance put options trade. Reliance is currently trading at 2,920 rupees. You have initiated a long put option trade on 2,900 strike price on 16th August 2024 and the monthly expiry is on 29th August 2024. Now, the premium of Reliance 2900 PE is 32 rupees. The lot size of Reliance option is 250 shares. So the total amount required for this trade is 8,000 rupees excluding the brokerages and charges. Now let me ask you two questions. What would be the profit and loss assuming the spot price of Reliance is at 2800 on the expiry day, that is on 29th August 2024? The second question is, what would be the profit and loss assuming the spot value of Reliance is at 2800 on 20th August 2024 or maybe any other date apart from the expiry date? The answer to the first question is fairly simple. We can straight away apply the P&L formula for put options and the answer will be a profit of 68 rupees. But this is for one share. Since the lot size is 250 shares, we need to multiply this profit per share with the lot size. Now this figure will equal to a profit of 17,000 rupees. But the answer to the second question cannot be obtained using this formula. If the spot price is at 2,800 rupees on any other day apart from the expiry date, the P&L figure is not going to be 68. Instead, it will be somewhat higher. We will discuss the reason why this will be higher in our upcoming episodes. But for the time being, if you are curious, you can check this using the strategy builder available in Sensible. Here you can see how the P&L changes with relation to the expiry. You can also see how the payoff graph is different for every day other than the expiry. Sensible is free for Zerodha users, and I suggest you try it out with different spot prices and different days till expiry. Now, I would like to wind this video up by giving you a brief summary of all that we have learned in these two episodes. To start off, as an options trader, you have four possible opportunities. You could buy a call or a put option, sell a call or a put option. You buy a call option when you have a strongly bullish view on the market. You expect the prices to soar. To buy a call option, you need to pay an upfront premium to the seller. You can also sell a put option if you have a neutral or slightly bullish view. You expect the market to stay flat or rise by some point. The benefit of selling a put is that you will receive the premium amount from the start and you will begin to make a loss only after this premium is exhausted. Now, if you have a neutral or slightly bearish outlook on the market, and if you expect the market to remain flat or move lower by a few points, then you can sell a call option. Here also, you will receive the premium amount in your account once you initiate a trade. And finally, you can buy a put option when you are strongly bearish about the market. You expect the prices to drop significantly. With these four variants of options, a trader can create multiple combinations and also create numerous strategies for different market conditions. So when you buy an option, it is also called a long position, and when you sell an option, it is also called a short position. Going by that, buying a call option and buying a put option is called long call and long put position respectively. Similarly, selling a call and selling a put option is called short call and short put respectively. So as I mentioned before, the abbreviation for call option is CE and that for a put option is PE. Now these are the P&L calculations for both the buyer and seller of call and put options upon expiry. This means these formulas are applicable only when the trader intends to hold the position till expiry. These P&L calculations changes when the trader intends to square off the position well before the expiry date. And finally, using the concept of P&L profiles of call and put options for four different scenarios, we have plotted the payoff charts for all of them. As you can notice, the payoff diagrams of call option buyer and call option seller look like mirror images. Similarly, the payoff diagrams of put option buyer and put option seller look like mirror images. The mirror image of payoff diagrams tell you that the risk-reward characteristics of an option buyer and seller are the exact opposite. The maximum loss of an option buyer is the maximum profit of an option seller. Likewise, the option buyer has unlimited profit potential, which means the option seller has unlimited loss potential. Another observation from these diagrams suggests that you should not buy a call option or not sell a put option when you anticipate the probability of a market decline. If you do such a thing, you will certainly lose money. The same can be said when you anticipate a possibility of market soaring. You should stay away from buying a put option or shorting a call option. Both will result in your loss. I genuinely hope you now have a solid understanding about the two types of options from the perspective of both buyer and seller. These are all the important things that you need to know, at least until this point. There are a lot more interesting concepts to learn. If this video was informative, please consider supporting our efforts. Please help this video achieve the target likes. Hit that like button right now. Comment down your queries and suggestions. Also share this video with your friends and fellow traders. And if you're new to our channel or you have not yet subscribed, please make sure to subscribe and also enable the bell notification to stay updated about our new video uploads. I will see you guys in the next episode. Till then, bye.